Thanks for watching Income Method Basics from High Dividend Opportunities. My name is Will Barton, and I am the lead analyst at HDO. This series has been curated to help you understand investing concepts and our methodology. In this episode, we're talking about bond ladders, what they are, why income investors use them, and how they can protect your portfolio from interest rate uncertainty. Let's start with fixed income. Fixed income refers to investments that pay a regular stream of income at predetermined intervals. This includes bonds, CDs, preferred stocks, treasury securities, and municipal bonds. Unlike stocks, most fixed income securities have a par value they are redeemed at, and with some exceptions, their payments cannot be paused without a default. That makes them a natural fit for income investors. So what is a bond ladder? A bond ladder is a portfolio of bonds or CDs that mature on different dates. Instead of putting all your capital into investments that mature at the same time, you spread them out across different years. Each year, a portion of your portfolio matures, and you reinvest those proceeds into new bonds at whatever rates are available at that time. The strategy solves two specific problems. The first is renewal risk. If all your bonds matured at once during a period of low rates, you would be forced to reinvest everything at unfavorable yields. By spreading out maturities, you never have to make that all or nothing decision. The second is cash flow management. A bond ladder gives you regular, predictable access to capital. You control when portions of your investment become available, which lets you take advantage of new opportunities as they arise, rather than waiting for a single maturity event. Here is the key insight behind all of it. Nobody can predict interest rates. Not professional investors, not economists, and not the Federal Reserve. Trying to time the perfect moment to invest in bonds is a losing game. A bond ladder removes that pressure. By staggering maturities, you automatically participate in different rate environments over time. When bonds mature during high rate periods, you reinvest at high coupons. When others mature during lower rate periods, the rest of your ladder is still generating income from previously locked-in yields. Building a strong bond ladder means combining different types of fixed income: investment-grade bonds, CDs, baby bonds, preferred stocks, and municipal bonds with varying maturities to balance yield, quality, and risk. The goal is not to guess where rates are going. The goal is to build a portfolio that pays you no matter where they end up. To put this income method concept to work and to unlock our full portfolio, consider subscribing to High Dividend Opportunities on Seeking Alpha.